Namaskar, good morning, good afternoon, good evening to all the people who have joined us from different parts of the world. My name is Aisha Ghani and I welcome you all to the much acclaimed talk show Phir Baaton Mein, co-sponsored by Tata AIA Live. Well, after an overwhelming response from our audience in India, today we have come up with a special edition for our NRI and OCI clients to help them make better and informed decisions on their taxations and their finances. So today we will be examining over the new budget 2023 and we will see of what it holds in store for our NRI and PIO clients. And we are very happy today to have with us an expert, a distinguished expert from LKS Attorneys, Mr. Sriram S. Mr. Sriram is a partner from the direct tax team at LKS Attorneys. He's an advocate, a practicing before the High Court, Bombay High Court, and a tax tribunals. He is also a chartered accountant with an experience of over 12 plus years in association with LKS Attorneys, and he has already regularly addressed professional forums on tax laws. Mr. Sriram S., we are very delighted to welcome you all to Phir Baaton Mein, co-sponsored by Tata AIA Live. And today, this special edition for NRI and our OCI clients, I'm sure we have a lot of constructive and productive information to be given out to them, because this episode has specially been curated after an overwhelming demand and request from our NRI clients.
Thank you, Aisha. Again, a good morning and a good evening to everyone. In the next half an hour or so, I would want to take you through the proposed amendments that are sought to be made in the Income Tax Act in India, which, according to us, would have certain impact on taxation of non-resident Indians and overseas Indian citizens. But before I go into the changes that have been proposed in the Act, I would want to spend a few minutes on what is meant by residential status, who is an NRI from income tax perspective, because that law has also undergone certain changes in the last 2 or 3 years. I also want to briefly touch upon the differences of treating an individual as a non-resident for income tax perspective vis-a-vis FEMA perspective, because merely because a person is non-resident for income tax perspective does not mean he's a non-resident for your foreign exchange regulation as well. In other words, an individual can be a non-resident for exchange control regulation, that is from the perspective of your banker, but can be a resident for the purpose of income tax regulations. I want to briefly touch upon that difference. I also want to give a broad background about what is meant by withholding tax, or TDS as we generally understand. After we go through all this, I will then take you through a few changes that have been proposed in the Finance Bill 2023. They have still not become an act, and it will become an act in the due course of time, the next 1 or 2 months. What are the changes therein that might have certain impact on the income that you might have in India, as well as income that you might have in foreign countries when you become a resident of India? We'll also specially concentrate upon the changes that have been brought about in taxation of monies received under an insurance contract. Then I'll be open to any question that the moderator and the participants might have. This is broadly what I want to cover the next half an hour or so. Now, what is meant by treating a person as a resident or a non-resident of India? This rule is nothing which is peculiar to India. All countries across the globe in their taxation regulations classify their taxpayers as residents and non-residents. In US, unlike considering a person as a resident or a non-resident, they go by what is called as a citizenship regulation. If you are a citizen of US, then you are considered as a person resident in India. India has not yet brought in that regulation in its full ambit. If a person is considered as a resident of India, then the income earned by that person from anywhere across the globe is liable to tax in India. For example, if we have, say, for example, one Mr. Patel who has been in the US for about 25 years or so, and after establishing his business in India, and after establishing the empire in India, retires and comes back and stays with his family in India, he will continue to earn income from his US assets created. Mr. Patel returns to India and for the whole of the year stays in India, does not have the intention to go back to US, but has created a business empire in India, out of which he will be receiving passive income. Let us assume that he has created business wealth in the form of real estate in the US and starts receiving rental income from the US. In such a situation, Mr. Patel, who will be a resident of India and deriving rental income from the US, will be liable to tax in India on the rental income earned from the US. On the other hand, if he is not a resident of India, he is a resident of any other country, the rental income from the US will not be liable to tax in India. The moment he becomes a resident of India, his income from all sources across the globe becomes liable to tax in India. If, on the other hand, let's take another example of a US resident holding shares, 1,000 shares, say for example, in Infosys in India. Permissible, he holds the shares. When Infosys declares dividend for the shares held by all shareholders, including, say, one Mr. John in the US, this dividend is derived from an asset located in India, namely the shares of Infosys in India. In such a situation, irrespective of the residential status of Mr. John, whether he is resident or non-resident in India, the dividend derived from the shares in Reliance Industries or Infosys will be liable to tax in India. To sum up, all incomes that have their source or link to India will be liable to tax in India, irrespective of the residential status. The requirement for determining residential status arises for income that are sourced from outside India, like in the example of Mr. Patel from immovable property located in the US. For taxing such incomes which have their source from not linked to India, one has to determine the residential status of a person. If that individual is not a resident of India, then the income which are derived from sources outside India are not liable to tax in India. On the other hand, if the source of the income is in India, irrespective of the residential status, tax liability arises in India. Now, from income tax perspective, the residential status can broadly be classified into 4 categories. Earlier, there are only 3 categories. In the Finance Acts that are the amendments that have been made in the last 2 or 3 years, the 3 has expanded to a 4th category as well. Let's broadly look at what are the 4 categories. I would also suggest that whatever I'm going to tell you in the next 4 or 5 minutes is something like you get is something like your over-the-counter medicines. What I'm going to tell you is not the exact answer to the particular queries that you will have, but only a broad guideline, and is strictly advised that whenever you have any issues that relates to residential status, where your stay in India is going to exceed, say, 60 days in a year. Let's keep this ballpark figure of 60 days of stay in India. If your stay in India is more than 60 days in the year, I will advise you to consult your chartered accountant or any professional to determine the residential status. This is because the law is slightly complex and is ever evolving. Okay, but the broad guidelines can be taken like this. There are 4 categories of residents in India for taxation purposes. One is a resident and an ordinary resident. That is a person who always stays in India. The second is the other extreme of a non-resident who always does not stay in India. The third category is a mix of both. That is, who does not always stay in India, but regularly comes to India. What we call as a person who is resident, but not an ordinary resident. And the fourth category that has now been created in the last 2 or 3 years is a person who is resident of no country, but holds an Indian passport, who is a citizen of India. I'll repeat, the fourth category is a class of persons who are resident of no country, but hold an Indian passport. The fourth category, by an amendment made in the Income Tax Act in the last 2 years, has been deemed to be a person resident of India. Now let us slightly dwell upon what each of these categories mean. A person or a resident and an ordinary resident is a person who stays in India for a minimum of 183 days in a year. If you are going to stay in India for 183 days, you automatically become a person who is resident of India. But some relaxation is granted to people who leave India for taking up employment abroad. So, and to people who ordinarily reside outside India and come to India for taking employment in India. For both these categories, the 183 days criteria has been reduced to 60 days or 120 days, depending upon the income that you have from sources in India. Okay. So broadly, the ballpark figure is, if you are going to stay in India more than 183 days, you automatically become a resident. If your stay in the previous few years exceeds 720 days, which will ordinarily happen in most of the cases. A few relaxation is granted for people who are leaving India for the purpose of taking employment abroad, or people who ordinarily reside abroad and come to India for the purpose of taking up employment in the country. That, and depending upon the other criteria of India sourced income. This is the first category of people who are resident and ordinary resident. The next category is of people who are resident but not ordinary residents. This class of residential status is created with the objective of granting some benefits to people who have always been non-resident but are becoming resident of India for the first time. As we saw a few minutes back, a person resident of India will be liable to tax on the global income, whereas a person not resident will be liable to tax only on the income that have their source in India. Take a situation of a person who returns to India after a long period of time and becomes a resident of India. He has amassed huge amounts of wealth outside the country. The Income Tax Act does not want them to be feeling a knee-jerk tax liability in India in the first year of their becoming resident. So this category of resident, which is referred to as resident but not ordinary resident, are those people who come to India after a long period of staying abroad and become resident for the first year. So a resident who is not an ordinary resident and becoming a resident for the first 2 years will be liable to tax only on the Indian sourced income. It's an exception created to the ordinary rule so as to give some breathing time for such taxpayers to get accustomed to Indian laws. The third category of residential status is a non-resident. A non-resident is ordinarily a person who does not fulfill these two residency criteria. But it quite often happens that a person becomes resident of both the countries, of two countries. Say, for example, you have a person of Indian origin, has his family in India, and has his business or employment in, for example, Dubai. So he would want to spend half of the year with his family and half of the year for work. And more so in these recent times of work from home, it is possible for a person to stay with his family in India and continue with his work abroad. So it might quite often happen that a person might become resident of both the countries. In such cases, that person, according to the domestic laws of both the countries, might be liable to tax in both the countries on the global income. He would be liable to tax on the income earned in India as well as in Dubai in India because he is a resident of India. Similarly, he will be liable to tax in the second country also. To avoid such economic burden on such people, India has entered into something called as a double taxation avoidance agreement with more than 100 countries across the globe. Those double taxation avoidance agreement provide that if a person is resident of both the countries, that is India as well as the country in which we are concerned about, then the double taxation avoidance agreement provides for a series of criteria to state that he will be determined as resident only of one of the countries. There are lots of rules for that. Predominant of them is to determine where his family stays. So if a person is resident of both the countries, by a default rule, if the person is governed by a double taxation avoidance agreement, he will be considered as a resident of the country where his family stays. Okay. There are third category, there is other category of what we call as residentless person. We saw that if you stay in India for less than 60 days, you will not be considered as a resident in India. So people align their stay in a country in such a way that they don't stay in any particular country for more than 60 days. Say, for example, there is 60 days in India, 60 days in Singapore, 60 days in Dubai, 60 days in the UK, and 60 days in the US. So they become resident of no country. I'm not saying they are stateless person. They will hold citizenship in one of the countries. Such persons who are resident of no country according to the domestic tax laws and holding a Indian passport is deemed by a recent amendment to be a resident of India. That's on the taxation front. Now let us come to the FEMA regulations. Many people confuse residential status for taxation and foreign exchange regulations. I will not want to go in depth about it, but broadly want to say from a foreign exchange regulation, your period of stay in India is irrelevant. What is to be seen is your intention to stay in India. So under the exchange control regulation, irrespective of a period of stay, if you intend to stay in India in the near future for a longer period of time, you will be considered as a person resident in India. On the other hand, even if you are going to stay in India for the whole year, but your intent has always been to move outside India because of your employment there, because of a family being there, for whatever reasons, you will be considered as a non-resident for exchange control regulation. Now, why does this issue arise in exchange control regulations? Once you become a non-resident, you are not allowed to hold a INR account. You necessarily has to reclassify your account into a NRE account or an NRO account. All of you would by now be aware what are the permissible credits and permissible debits in an NRE and an NRO account. I don't want to go into it because it takes some time. All I want to highlight is once for exchange control regulations, you are considered as a person not resident of India, then there is an obligation on you to intimate to your authorized dealer or a banker to reclassify your account into NRE or NRO account, depending upon how you want to classify your account. Just talk to your authorized dealer. They will explain to you what are the advantages, disadvantages of both these accounts. That's all I wanted to give you about the background about these residential status. Moving on to the next topic of this withholding taxes. Whenever you earn any income from India, the person paying the income is obligated under the income tax regulations to deduct your income tax liabilities from before paying the income to you. If we can move to the next slides, we will see the next slide, please. whenever you have an income source from India, before the amount is paid to a non-resident, the tax on that income will be deducted at source, which we call as TDS or withholding taxes. If a non-resident has an immovable property in India, say for example, a house property in India which is let out, the rent from that is liable to tax in India because it is sourced from India. Before the rent is paid to that non-resident, remitted into either an NRI or an NOR account in India or abroad, the tenant is obligated under the income tax regulation to deduct tax on that rental income. The concept is equally true for, say, for example, dividend that you earn from India. Or if you are going to sell your house and earn a capital gain on that, that will also be liable to TDS or withholding tax in India because the income is taxable in India. Or if you sell your shares of an Indian company, the purchaser, before remitting the proceeds to you, will deduct the tax liability on that transaction and deposit to the income tax department and will remit only the balance to the non-resident's account. The liability to withholding tax or TDS will not arise if the income is not taxable in India. For example, if you receive a gift from your parents or your relatives in India, merely because the remittance is made from India to a foreign account will not mean TDS is applicable on the transaction. Unless the remittance is liable to tax in India, the withholding tax would not apply. Similarly, if there is proceeds out of a life insurance policy payment, which fulfills all the conditions given, like your premium payable is not more than 10% and all those criteria, then that remittance will not be liable to withholding taxes in India. Withholding taxes can be exempt, as is explained in the next slide, by two methods. Either the Income Tax Act itself can grant an exemption from applicability of taxes, for example, gift, or for example, the payment of life insurance, payout from a life insurance policy. Both these payments are exempt from taxes under the Income Tax Act itself. The second and the more important aspect of exemption from Income Tax Act is derived from the double taxation avoidance agreement that India has entered into with many countries. This aspect of exemption and double taxation agreements has to be examined a bit closely, and I would advise you to talk to your consultant or your investment manager or your portfolio manager on availability of these exemptions. This can change depending upon various criteria. Broadly put, a person, for example, resident of Netherlands, if he sells his shares in an Indian company, he will ordinarily be liable to tax under the domestic law, but under the double taxation avoidance agreement between India and Netherlands, he might be eligible for certain exemptions. He will not be liable to tax in India. Similarly, many of these Southeast Asian countries, like for example, Dubai or UAE or any other country for this example, Oman. The double taxation avoidance agreement between India and those countries say that the income from other sources, which are ordinarily not liable to tax from other sources, for example, your payment out of life insurance premium, those incomes will not be liable to tax in India, despite there being no exemption of the Income Tax Act. Okay. So such exemption are conferred upon by these double taxation avoidance agreement. Now, how do you apply these double taxation avoidance agreement? Such non-residents will have to apply to their domestic tax authorities and obtain something called as a tax residency certificate. In most countries, this is an online process. You make an application online, including in India. You make an application online, next 2 or 3 days, the authorities verify the data that is available with them and then issue a certificate in electronic medium. You get that certificate, transmit that to the person who is resident of India and examine whether you are eligible for any benefit across. The next point that we have to see is how to avoid this withholding taxes. There are 2 ways by which you can avoid it. First, as we saw in the last 2 or 3 minutes, examine if you are eligible for this exemption double taxation avoidance agreement, and if so, procure the certificate and issue it to that person who is paying you the income, and he will not deduct the TDS. Second is, if there is any transaction in which, say for example, you're incurring a loss. You purchased a house for 1 crore and you want to sell it for 1.5 crores. Ordinarily, economically, you are earning a gain, but because of certain exemptions providing Income Tax Act, for example, you get indexation benefit, because of which this 1.5 crores sale results in a loss. Then you have the option to apply to the Indian tax authorities, tell them that you are incurring a loss in this transaction, and therefore ask the person remitting the amount not to deduct tax on that. It ordinarily takes anywhere between 4 to 8 weeks to get that certificate, but Indian tax authorities are forthcoming to issue a certificate for entailing remittance without deduction of TDS. Now, next topic that I want to touch upon is what happens to remittances made by life insurance companies on payments made to non-resident on life insurance contracts. We will look into it in a bit more detail in the later part of the slides when we see that the exemptions that have been given is withdrawn. But broadly speaking, the Income Tax Act itself grants an exemption to payment made out of life insurance contracts. But there are certain thresholds. Like, for example, if you hold a ULIP and the ULIP, this unit-linked insurance policies, and the premium payable on the unit-linked insurance policies in a year is more than 2.5 lakhs, the exemption is not available to you. Or you hold a life insurance policy where the premium payable is more than 10% of the sum insured in any of the years. Then again, you will not be eligible for the exemption. In such cases, the life insurance company, before remitting the sum to you, will deduct TDS on that if you are a non-resident at 30%. If you are a resident, the tax liability is only 5%. If you are a non-resident, then the withholding tax liability is up to 30%. But if you are a person resident of certain countries, like for example, Oman or Dubai, you will be eligible for certain exemption as per double taxation avoidance agreement. So before you surrender or before any of your life insurance policy matures, please talk to your agent or talk to your corresponding asset manager and examine if you are eligible for the exemption and submit those documents which are being called for to receive the sums without deduction of taxes. Now, I'll now go to the changes that have been sought to be brought about by the finance bill. Excuse me. There are about 122 changes that have been sought to be brought in by this budget. I will not go into all of them. I'll only want to highlight 3 or 4 that will have impact on taxation of individuals and more particularly non-residents. Many people who are holding properties in India, say the properties have become old and they want to go for a redevelopment of the property, or the property was too small when they had acquired for their family to stay and want to move about to a larger property, adopt this principle of selling the property and then purchasing a new house property. Income Tax Act grants exemption from taxes for gains that you derive from sale of one property and if you invest in another property. Of late, the government has been seeing that the ticket size of these reinvestment properties have been exorbitant amounts. Like, for example, people have been making gains of, say, 200 crores Indian rupees and claiming exemption on that by reinvesting in huge lavish properties, say, for example, which again cost 200 crores. The income tax exemption was brought about way back to grant exemption to, as we say, an aam aadmi, a middle class individual. They don't want this exemption to be extended to high net worth individuals. And with this objective in mind, the Finance Bill has now sought to amend the income tax regulation to say the exemption will be capped to Indian rupees of 10 crores. Whatever be the amount that you invest in a property, it is not saying that you cannot purchase a property of a higher value. The exemption seeks to cap the exemption. The amendment seeks to cap the exemption to investment up to 10 crores only. even if you invest in a property of 150 crores and you are ordinarily eligible for the exemption up to 150 crores, post 1st of April 2023, the exemption would be capped at 10 crores. On the balance 140 crores, you will be liable to income tax in India on such gains. The next amendment that might have certain implication on non-resident investors or non-resident Indians is in relation to market-linked debentures. Ordinarily, a debenture will have a certain coupon rate, an interest rate. But borrowing from foreign investment criteria or foreign investment managers, India has introduced something called as market-linked debentures, where the interest rate is dependent upon certain criteria like your movement in the price of a share or movement in the index. Such market-linked debentures were earlier taxable as capital gains and therefore liable to tax to a smaller amount of say 20%. Going forward, such market-linked debentures, which the gains from such market-linked debentures is considered to be taxable as short-term capital gains and will therefore attract tax of 30%. Earlier, indexation was available on such capital gains and the rate of tax was only 20%. But going forward, that is for transactions post 1st of April 2023, such marketing debentures will be gains from such marketing debentures will be liable to tax at 30% broadly. The next amendment is in relation to gifts which are received by non-residents. We saw that a non-resident is liable to tax only on income that accrues in India. If you have a relative in India, say for example, father staying in India and son or daughter staying abroad, or the vice versa, gift is ordinarily not taxable. Gift from relative is also not taxable. But if you have a gift from a non-relative, relative has a definition in the Income Tax Act. People who are very close to you can be non-relative and the vice versa. If you have been grown up with your, say for example, a niece, both of you are very close and you receive a gift from your niece in India, your niece might not fall within the ordinary definition of a relative in income tax regulations and therefore the gift might be taxable. Earlier, the law was amended 2 years back to say that any gift received by a non-resident from a donor in India will be liable to taxes in India, irrespective of the fact that the gift does not accrue in India. Now the law has been amended to say this taxation will not only apply to non-residents, but will also apply to residents who are not ordinarily residents in India. A small amendment being made, but will have significant ramification going forward. Now, coming to the next and the most important amendments in relation to taxing of monies received under insurance contracts. Historically, any money received under an insurance contract across the globe was not taxable at all. There was no section which brought that sums to charge in India. But this exemption was being misused by many people to use insurance contract as an investment vehicle. Slowly over a period of time, the Parliament in India is bringing about changes to this exemption so as to do away with these exemptions, so as to do away with the exemption otherwise granted. This is not a change that is peculiar to India. The US brought about these changes in the 1980s itself. India is slowly coping up with it. A few years back, the law was amended to say if the premium payable on insurance policy is more than 10% of the sum insured, the exemption will not be granted to such policies. Last year, the law was amended to say in relation to unit-linked insurance policies, though they are life insurance policies, if the payout is linked to the market value of units, then if the premium payable for any year is more than 2.5 lakh rupees, exemption will not be granted to you. Now, those criteria for granting the exemption has been widened by the finance bill, as we can see in the next couple of slides. By the finance bill 2023, it has been proposed, or two changes rather have been proposed. The first change is an exemption in relation to a particular policy. This is what we call as a policy related, insurance policy related change. If in any policy which is issued post 1st of April 2023, the premium payable in any year is more than INR 5 lakh rupees, then any proceeds that you receive from that policy will be ineligible for the exemption. I'll repeat. If there is a policy on which the premium payable is more than 5 lakhs in any year during the term of the policy, then any receipts from that policy will not be eligible for the exemption, which implies that you will be liable to tax on that sums. An exemption has been granted to money receivable on the death of the person insured, the sum insured. Except where the money is received on death of a person, if you receive it on maturity of the policy or assignment of the policy or surrender of the policy, and if the amount payable in the premium payable in any of the year is more than 5 lakh rupees in a year, exemption will not be available to such policies. Thankfully, this withdrawal of exemption is applicable only to policies that are issued post 1st of April 2023. If any policy is issued prior to that date, say for example on 31st of March 2023, and the annual premium payable is more than 5 lakhs, you will still be eligible for this exemption. The next amendment that has been brought in is in relation to a person-specific restriction. If you have more than one policy, either from the same insurance company or a different insurance company, the premium payable on each of the policy is less than 5 lakh rupees, but the aggregate of the premium payable is more than 5 lakhs, as we explained in the next slide. If you have, say, for example, a person has 3 insurance policies from 3 different insurance companies, premium payable on each of them is more than 2 lakhs, is 2 lakh rupees, aggregate comes to 6 lakhs. This amendment says if the aggregate of premium payable in any 1 year is more than 5 lakhs, you will still not be eligible for the exemption. This again is applicable only for the policies which are issued post 1st of April 2023. The next criteria for denying the exemption is if a single person takes 3 different policies on people having insurable interest. Say, for example, he takes a policy on his own name, his wife's name, and his daughter's name, all having 2 lakhs rupees as premium payable in a year. Given that the aggregate premium payable on such policy is more than 5 lakhs, any money received on such policies upon their maturity will not be eligible for exemption. How are they going to track these policies? They will come up with some, the CBDT will come up with some policies to fix some procedure to track them. Again, this exemption will not be denied if the money is received upon death of the person insured. Okay. There have been certain consequential amendments that have been made to the other income tax regulations to grant, to to make this amendment effective. Okay. We need not go into all these things. So broadly speaking, in relation to policies that are to be issued, fresh policies that are to be issued post 1st of April 2023, if the premium payable on a single policy or on aggregate of policies by a person exceeds 5 lakh rupees, then any money received on surrendering of that policy will be liable to tax under the domestic law. You would still be eligible for exemption under double taxation avoidance agreement, which you have to independently see. As the law stands today, or the double taxation avoidance agreement stands today, a person resident of Dubai or Oman will not be taxable even as per the amended law when he receives money on maturity of such policies. That has to be seen on a case-to-case basis. This is all that I want to highlight to you in relation to the amendments. Now I'm open to any questions from moderator or the participants. That's all from my end. There are 2 examples that I had quoted, but we need not go into. Over to you.
Thank you very much, Mr. Sriram. I think there was really very informative and constructive pointers that were shared, and we had a lot of audience complimenting and also asking the questions at the same time. So from LKS Attorneys, we thank you for being a part of this session, Phir Baaton Mein, co-sponsored by Tata AIA Life. And there are a few questions if you'd like to answer.
Yeah.
Yeah, so I think this is the most asked question, and I'm sure you have also answered it in your session, but I would still want to reiterate on this fact. The question is from Mr. Nikesh Shah from Leeds, UK. So he asked the question saying whether the rupees 5 lakh limit applies to the NRI or OCI also.
Absolutely, yes. It is applicable to every person, irrespective of your residential status.
Irrespective of the double taxation law that you stated that the countries have with each other, this will stay applicable.
This 5 lakhs limit will apply to a person, irrespective of his residential status, even if he's an NRI. But if Mr. Shah is not a resident of US, but a resident of Dubai, then certain exemptions are given to him by the double taxation avoidance agreement between India and UAE. That exemption is not conferred on the income tax regulation, but on a separate treaty between these two countries. But the thumb rule is this 5 lakh limit applies to all NRIs.
Yeah, so irrespective of a person from any residential status or any country, this will be applicable. All right, so there's another question which was asked, which is from Ms. Sujata Reddy from Riyadh, Saudi Arabia. She asked, what will be the tax implication on the proceeds of the insurance received on the death of an NRI or POI?
No tax.
So that remains the same as the Indian budget 2023 as well.
But this is the rule across the globe. Okay, no country till today has sought to tax proceeds from death. Proceeds received upon death under an insurance policy. The exemption is maintained in India till now.
All right, thank you. So there's another question by Mr. Shukla from Paris, France. He wants to know that on life insurance, so his father lives in India and he wants to buy a life insurance policy from an Indian agent for his grandson in Paris. So what will be the tax changes on the maturity payout in his grandson's hands?
So when an Indian resident takes a fresh policy on say for example, he takes a policy after 1st of April 2023 on a person having an insurable interest who is residing in France. If the premium payable on that policy by the grandfather in India or any other policy put together exceeds 5 lakh rupees, then on maturity, the money received by the grandson will be taxable in India.
Okay, irrespective of grandson staying in India or not.
True. If the premium payable is less than 5 lakhs, then it will be exempt.
Okay, I think that's a very vital point, which most of the people had this question. Thank you for answering that. We have another question from Miss Vinita from Dubai. She wants to know what will be the tax on maturity amount of the life insurance if the premium is 10 lakhs per year, but is paid using the NRO account. Is there any difference?
It will not make a difference. The source from which you pay the premium, whether it's an INR account or a foreign currency account, remittance from abroad, NRI account will not make any difference on the tax liability. It purely goes upon the amount of premium rather than the source of the premium.
So, Mr. Sriram, is this the recent change which has been made, like in the budget 23, or was it applicable before budget 23 as well?
No, the budget change only caps the amount of premium. It does not, either before the budget or after the budget, does not deal with the source from which the money is paid. There is nothing in relation to that. Therefore, it is irrelevant from where the money is paid.
All right. So the bare minimum, the system that has been set, that will be followed irrespective of the account which it is driven from. All right. So there's another question from Brisbane, Australia. Mr. Gopal Krishna asks, what are the tax regulations to be kept in mind for an NRI to buy a policy from India vis-a-vis country of residence?
I would suggest that don't go by tax exemptions which are provided to the insurance policy based upon these treaties, because these double taxation avoidance agreements are economic agreements between government of two countries. They can be changed anytime. These policies are long-term assets for you. They are, say, for example, you will receive the maturity after 15 years. The exemption that is granted today might be withdrawn in the double taxation avoidance agreement after 15 years. Go purely by the exemption that is being available under the domestic law in India. So if you are a resident of Australia, Australian double taxation avoidance agreement does not grant you any particular exemption. Therefore, limited exemption will be available in Income Tax Act only. So therefore, the only point that you have to keep in mind to enjoy the exemption is the premium payable on the policies, fresh policies that you take should be less than
5 lakhs.
INR 5 lakhs. That is the only criteria that you have to look at.
Only criteria to be followed. All right, thank you. There's another question by Mr. Amrit Desai from South Africa. He asks, what are the different milestones an NRI should consider for buying the policy in India? Because previously, as you also mentioned, that many of the NRIs and many of the people considered life insurance as a way of investment, right? So I think with the budget 23, this has been taken out of the picture now. So what do you think are the different milestones an NRI should consider for buying the policy in India, other than setting the target for 5 lakhs, as you mentioned?
Nothing else. You should only see that the fresh policy that you take post 1st of April 2023, premium payable on them should not exceed 5 lakhs. For policies taken before that date, you can happily enjoy the exemption even after next 50 years. But for policy taken after that date, you will not, your premium payment for those policies in aggregate should not exceed 5 lakhs. That's the only thumb rule, nothing else. Rule is simple.
So that applies to NRIs and the residents of India. Right. So are there any special privileges? So we have understood that the thumb rule remains the same for both the countries. Now, is there any special privileges which are assigned according to the new budget 23 to the NRIs or OCIs? Is there any special privileges that has been granted?
There is no special privilege per se granted to non-residents. Only benefit can be taken by residents who are countries of a few countries, who are residents of a few countries like UAE or Oman. That exemption again is not something which is being granted by this budget. That exemption always existed. It is being highlighted now because a sum which was otherwise exempt is now being brought to tax in India. So residents of few of those countries in Southeast Asia or these opaque countries, as we can call, will be eligible for exemption if they are resident of that country at the time of maturity. So you can be an Indian resident for 10 years, pay the premium in India. The policy matures in the 12th year. In the 12th year, if you are a resident of Dubai, your income will be exempt from taxes.
All right. So even if it exceeds the 5 lakh premium, as you mentioned, yes. So at the time of maturity, if the person is not a resident of India, so that law will be applied and it will be exempted from the tax laws of India. Is that? I
would not put it as being not resident of India. I would say person resident of Dubai.
Okay, so you mean staying for less than 183 days in India as one of the criteria that you mentioned?
No. You stay in India for less than 183 days. But if you stay, so for example, Perth in Australia, you will not be eligible for the exemption. If you stay in Dubai and become a resident of Dubai, as the law stands today, you will be eligible for the exemption.
Okay, I think that's a very important and a vital point. That's why I wanted to reiterate on the fact. So thank you very much, Mr. Sriram, for this bit. So there's another question. I'm sure you're up for a few more questions. This session has been received very well by all our NRI and global friends. So there's another question by Mr. Sumit Soni from Australia. He says that I'm an OCI staying in Australia. Can I buy a policy for my wife who is still an Indian citizen, what will be the tax on such policy in India and Australia? In India, you have explained that to us. In Australia,
the liability to tax has to be seen at the time of maturity of the policy. If the person receiving the money at the time of maturity of the policy is a person resident of India, then they will be liable to tax in India if they don't meet the 5 lakhs criteria. That will have no tax liability, in my view, in Australia. You will again have to check the domestic laws of Australia, but per se will have no tax liability in Australia because the proceeds are paid in India, the money is received in India, no problem at all. If, on the other hand, at the time of maturity, she moves to Australia and becomes a resident of Australia, then the money maturity amount becomes taxable in both the countries, in India as well as in the Australia, subject to some exemption which is being granted in Australia. If there are no exemptions granted in Australia, this money may be taxable in Australia also. In such a scenario, she will first have to pay a TDS or withholding tax in India, and so much of tax paid in India will be available as credit against the tax payable in Australia.
Okay, so with respect to double taxation law, can it not be saved as you mentioned in the earlier slides?
If she is a resident of Dubai, then it can be saved. But if she is a resident of Australia, then no exemption is being conferred by the double taxation agreement with Australia. These double taxation agreements are bilateral agreements.
Yeah, so it depends on the treaty that one country has so India has with other countries. So it all depends on that. So I would request all our viewers to kindly analyze and understand the treaty that is there between India and their respective countries to make better and informed decisions. I think that's the right way to go about it. Thank you, Mr. Sriram. There's one last question I would like to take. This is from Mr. Vishal Gopal from Singapore, and he asks, what is the most preferred mode for an NRI to buy a policy? Digital?
I leave that question to you.
What do you recommend?
There's nothing the Income Tax Act prescribes or prefers as to what are the modes that you want to purchase it from. You can purchase it from your INR account, you purchase it from your foreign account, you purchase it online through an agent, through an intermediary who is an online. That's not a decision which is governed by which is carried away by your income tax regulations.
All right. So, Mr. Sriram, as I said, this session is so overwhelmingly received by our audience. I have a few more questions. If the time allows, would you like to take a few more?
Absolutely. I'm free.
Okay. Mr. Swapnil asks from Dubai, says, for Dubai and Oman, you said insurance maturity proceeds won't be taxed if exempt in India. Will the insurance maturity be taxed in USA if exempt in India?
If it is exempt in India, then Indian withholding tax will not apply. Okay. To determine whether it is resident in USA, you will have to see the domestic laws of USA.
Okay.
In Dubai and Oman, we don't have a personal taxation. Therefore, we will not be liable to tax in those countries. But in countries like Australia, US, or the UK, whether such policies are exempt from taxes in those countries will have to be seen according to the domestic laws of those countries. Domestic. And I can assure you those are more complex than ours.
I'm sure about that. Another question, Mr. Pavan asks, he didn't write his country. He's asked, income from rental property in India and DMAT account, how to file taxes easily?
It's now the income tax department has come out with online forms that can be filled by taxpayers themselves. But I would suggest you can contact a chartered accountant or your financial advisor in India to take assistance in filing. It's not very difficult. It's very simple. Your amounts will be liable to taxes. TDS would have already been deducted. All you have to disclose is the details of your income and TDS. And all of them have been made automatic now. It's quite simple, not that complicated.
Thank you for the advice. There's another question. Yes, tell me please.
The details of the forms, everything is available online in the Income Tax Department's portal.
Yes, now it has become more lucrative towards the needs of the people. All right, so there's another question by Mr. Swapnil again. He says, how can NRI purchase an insurance policy? Can he directly send money from his US bank account to his written Tata AIA account in case of GRIP product, where NRI start getting his pension from 5th year, does Tata AIA directly remits to US account, or NRI is required to open an NRI or an NRO account? Do you need to have 15 CA or CB certification to be obtained to credit to the NRI account, either in India or outside India?
For taking a policy, the premium payment from abroad, there is absolutely no restrictions under the foreign exchange regulation. You can remit it from. On maturity, how would Tata AIA remit the proceeds? That you will have to check internally. What has been your policy for Tata AIA's policy for so long a time? The law has not undergone a change. You just check what is the policy being adopted by you internally, and then you can respond to him.
Okay. There's another question by Syed Azam Babu. He asks, I think you've already answered this question. He's again asking that money received from insurance company which is exempt in India, will it be taxed in my hands in USA? So I think the answer depends on the domestic law of USA.
Correct.
Right? Correct. All right. So we are flooded with so many questions and compliments for you, Mr. Sriram. Thank you for taking this session for us. I think it's a fantastic session that has been laid out in association with Tata AIA. And thank you again for sparing out your time. I promise this is the last question, okay? So Mr. Ravi Chandran asks that in April 23, I invested 40 lakhs premium amount paid. Then after 6 months, he invested 2 lakhs in October 23. Is the first 4 lakh policy maturity amount be taxable?
Okay. So it's not 40 lakhs. He says there are 2 policies that he takes post 1st of April, 4 lakhs and 2 lakhs. So aggregate going up to 6 lakhs, which exceeds the 5 lakh limit. In such a scenario, the Central Board of Direct Taxes will come out with a rule to determine how to tax you on the policy that exceeds 5 lakhs. Definitely, their intention is not to tax you on the policy which is less than 5 lakhs. Exemption will be conferred upon you. But how will they grant that exemption is something which we have to wait and watch, because the rules are yet to come out of that.
All right. So as you said, 5 lakh limit is for the policy. Another 2.5 lakhs is for the ULIPs. So this applies for NRI as well. So total 7.5 lakhs can be done together with policy.
Those are independent conditions.
Okay. So that has to be studied before making the.
Like for example, if you take only a ULIP for 4 lakhs, merely because it is less than 5 lakhs will not mean the ULIP is exempt from taxes.
Okay, so ULIP will only be considered for 2.5 lakhs. So even if it is 3 lakhs, you are still liable to
pay tax on ULIPs.
Okay. So there are more things between the lines that has to be read in order to make a better and an informed decision. But I think your constructive session and it was really productive. All our audience loved it. We had a audience of thousands joining us from across the globe. So thank you very much to LKS attorneys, and thank you, Mr. Sriram, for being a part of Phir Baaton Mein, co-sponsored by Tata AIA Live. We thank you for joining us here with us.
Thank you. I hope I added some value to the participants.
Absolutely, you did. Thank you once again. And thank you to all our viewers for always showering us with so much of love and so much of adoration from around the globe. We loved to be a part of Phir Baaton Mein. We are going to see you back next with another series of episodes which will be productive, which will be informing, and which will help you take better decisions in taxation, in finance, and in life. Thank you very, very much once again. Phir Baaton Mein with Aisha Khani.